Debt has developed a terrible connotation in recent years, but the truth is, not all debts are terrible. In reality, you might benefit financially from some debts. But first, it's critical to comprehend the difference between good and bad loans. You are able to accumulate assets that will appreciate in value thanks to the deductible loan interest. The money from the investment can then be used to pay off debt and purchase items like shares, real estate, and mutual funds. Unpaid credit card balances, personal vehicle loans, and mortgage loans are examples of bad debt since they are used to buy depreciating goods, services, or assets with non-deductible loan interest. So, are you interested in hearing the 7 ways that rich people can make money with debt? Then please like this video and subscribe to our channel for future updates. With that out of the way, let's get started. The differences between good debt and bad debt. It's critical to comprehend the difference between good and bad debt. A good debt is one that enables you to amass assets that will appreciate in value. The interest on the loan is frequently tax deductible, and you can utilize the income generated by the asset to pay off the debt. Property, stocks, and investing in managed funds are some examples. Bad debt is the kind that is used to purchase items, services, or assets that have no chance of earning any money and slash or lose value over time. There's no income from the asset to pay off the debt, and the loan interest is not tax deductible. Examples include credit card debt that is not paid off within the interest-free period, personal loans used to purchase automobiles, and the majority of home mortgages for families. Using the power of good debt, you can take a number of actions to set up your personal finances so that you can begin using good debt to build wealth. Here are 7 of the best. Number 7. Debt consolidation. Extending the term of your mortgage and using the extra income to pay down bad, inefficient debts like credit card balances and personal loans can frequently be helpful. Servicing numerous debts will undoubtedly cost you significantly more money and interest and fees than you should be paying. Your house loan payments won't change, but you'll use the lower interest rate to pay down debts with higher rates of interest. Except if you use a balance transfer card with no fees. Debt consolidation loans and balance transfer cards function similarly and have a comparable 0% APR duration. However, there are several key differences when you obtain a loan for consolidation. Debt should not be transferred from one account to another. Your bank account will immediately receive the funds, which you can use to pay off your credit card debt in full. Then, over the course of the time period you selected when you applied for the loan, you make monthly payments to your lender. The credit line ends when a personal loan is repaid, and you are no longer able to use it. Cards with balance transfers let you transfer debt from other cards and pay no interest for a predetermined period of time. The best ones last between 15 and 21 months before a hefty interest rate takes effect. The majority of debt consolidation cards have a fee, a minimum salary requirement, and credit requirements. Add up all prospective income streams, including the balance of your 401k and savings account, and do not simply list your wage on your application, but also that amount. This will increase your likelihood of getting one. The interest rates on debt consolidation loans are lower than those on credit cards and allow you to borrow more money. These rates are based on your credit history and the amount of debt you owe. The temptation to spend that money instead of paying off your debt might be removed with a lender that sends money directly to your creditors. Number 6. Making your savings work harder. To feel more secure, many people choose to keep money in an emergency fund or a buffer account in their cash savings bank account. The process of buffering is this. The truth is that this money would be better off in an offset account linked to your mortgage, where it would produce a superior after-tax return and shorten the length of your mortgage loan without requiring any more contributions. Number 5. Better cash flow management. Revenue is often referred to as vanity, cash is reality, and profit is sanity. This is valid in a variety of facets of life. The beginning and end points of financial management are cash. As soon as you don't have enough cash on hand to fulfill your business expenses, running your business becomes challenging. A crucial part of managing your cash flow is anticipating when you'll have money in your bank account, figuring out how to acquire more of it more quickly, and knowing how to control your spending to prevent cash flow issues. An essential component of properly managing your company's finances is having a solid understanding of cash flow management. Once you've mastered this, you can consider ways to expand your company while also raising your margins and profits. Managing cash flow effectively is essential for lowering bad debt. The reduction of interest payments is the main objective. You can do this by making your mortgage payments more frequently, by raising the amount paid putting your whole paycheck into an offset account, or using a credit card's interest-free period to pay for daily costs, you can free up more money to pay off your mortgage early and interest-free. Number 4. Borrowing to create wealth. It's time to develop some good debt once you've minimized your bad debt. This is known as gearing, and if you invest well and your assets grow over time, gearing can help you develop wealth. This is so that the investment's income and capital growth may pay off the loan and exceed the cost of debt servicing. In this circumstance, purchasing real estate or stock options is frequently a sensible investment strategy. You can also raise the additional funds you need by taking out a margin loan, home equity loan, or investing in a managed share fund. Gearing, also known as leveraging your investments such as real estate or equities, can be a potent strategy for long-term wealth creation. Compared to what would normally be possible without borrowing money, it enables you to buy more investments. Using leverage to finance your investments could lead to a higher overall return as long as they increase in value over time. Once interest and other loan-related expenses have been factored in, the loan, interest, and fees incurred may be repaid using money gained from the assets, such as capital gains and income. Tax deductions may be available for interest paid on the debt. However, there's always the chance that your investment's value could drop, leaving you with a debt greater than the worth of your assets. Your investments may be subject to legal possession by the lender. If you are unable to pay back the loan due to unforeseen events, such as a spike in interest rates or a protracted period of unemployment, in the worst-case scenario, you can lose more than your initial investment funds, depending on how much money you borrowed to invest. Number 3. Using lump sums wisely. Periodically, you might get a significant lump sum of money from bonuses, inheritances, or other sources. You might try to pay off bad debt with this money, or think about increasing your superannuation payments, or instead of spending a large amount of money when you receive a lump sum, such a bonus or the investment maturity amount, put some of it into your current mutual fund, which will help you in 2 ways by increasing your money's growth rate. Either way, you can finish it before time runs out. The amount you receive at maturity will exceed the intended amount if you decide to keep the 10-year fixed. Number 2. Debt recycling. Reinvesting your equity in stocks or other assets while paying off your mortgage is referred to as debt recycling. By doing this, you turn bad debt into good debt that can pay off the loan and give you tax benefits while also generating an income for you. Any extra money also be put back into your mortgage, which will help you pay it off faster and save more on interest. By converting a portion of your inefficient debt that does not produce capital growth or income or is not tax deductible into debt that does provide capital growth or income or is tax deductible, you can gradually build wealth. Number 1. Invest in a geared managed share fund. Because managed share investments are internally geared, you can make them without getting a personal investment loan. You can still make money off of the gearing effect of borrowing money to invest, though. Basically, to finance investments in domestic or international stock markets, fund management borrows money at wholesale rates on behalf of the client. It may go against the prevailing wisdom that debt harms one's financial situation. However, debt can enable people to acquire purchases they otherwise wouldn't be able to afford, considerably improving their returns when handled efficiently and managed adequately. Well, that's it for today. What did you guys think of our video? Feel free to share your thoughts in the comments section below. Don't forget to click the like button and subscribe to our channel for more future updates. Thanks for watching.